Hello and welcome to Simplicity in Stocks. When volatility is the norm in the stock markets, hoping that your portfolio will keep going up is not a plan, it's a gamble. That's why market veterans like dividend stocks. These stocks provide consistent, dependable income by the way of regular dividend payouts. In this video, we are looking at three high yield dividend stocks delivering strong, steady cash flow. If income from stocks is what you are after, then these three stocks deserve a close look. Please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Coal India. Coal India is a Maharatna company that contributes more than 70% of India's coal production. It also holds 48% of India's proven coal reserves. The company's revenue has grown at an 8% compounded annualized growth rate or CAGR over a 5-year period and has delivered a net profit CAGR of 16%. The last 5-year average ROE or return on equity has been 47%. It's a steady and consistent dividend payer. At the time of recording, the stock had a 6.7% dividend yield. Looking ahead, the company's performance is expected to remain healthy. It plans to fund capital expenditure largely from internal funds, even after large dividend payouts. This indicates a strong financial position that is capable of generating sufficient cash flow to maintain its dividend policy. Indian Oil Corporation. IOC is India's largest refining and marketing company. It operates an integrated business model covering refining, marketing, pipelines, and petrochemicals. The company has 31% market share in domestic refining, with a capacity of 80.8 million metric tons per annum. This is spread across 11 refineries. IOC also controls more than 50% of the total pipeline network in the country, exceeding 20,000 kilometers. In its marketing segment, IOC has a network with over 40,000 retail outlets, nearly 13,000 LPG distributorships, and almost 6,000 aviation fuel stations. The company has delivered a top-line growth of 9% CAGR over a 5-year period and a net profit CAGR of 23%. The last 5-year average ROE has been 13%. The company is a consistent and steady dividend payer. At the time of recording, the stock had a 2% dividend yield. The dividend yield should improve going forward as payouts increase. In FY25, profits were down, which limited the dividend payout. Company also did not receive its LPG subsidies from the government for that year. So when it does receive the unrecovered subsidies, its earnings will go up and along with it the dividend too. Major expansions are also scheduled to be commissioned from FY26 and FY27. As these new projects begin to generate cash flow and the capex requirement tapers off, the free cash available to the company to pay dividends should rise. Castrol India. Finally, we have Castrol India engaged in the automotive and industrial lubricants segment. The company holds a leading position in the Indian lubricants market. It is the world's third largest in its segment, accounting for 10% of the global demand. It has also expanded into auto care products such as chain cleaners and anti-rust sprays. Beyond the auto sector, the company is focused on industries like marine, steel, mining, aerospace, cement, wind, railways, and machinery manufacturing. In these sectors, the company delivers tailor-made solutions and specialized industrial lubricants. The company has delivered a top-line CAGR of 7% over the last 5 years and a net profit CAGR of 2%. The last 5-year average ROE has been 44%. The company is cash-rich and debt-free. Historically, it has paid, on average, over 70% of its earnings in dividends. At the time of recording, its dividend yield was 3.85%. Looking ahead, the overall market for Castrol's portfolio is anticipated to grow in the range of 4 to 5% over the next 2 to 3 years. The management expects to maintain operating margins in the range of 22 to 25%. The market for cooling solutions for data centers in India is also expected to grow at 20%. While this is currently a negligible part of Castrol's P&L, This segment is anticipated to become significant and profitable over the next 10 years. Castrol will focus aggressively in the data center space, leveraging its leadership in technology. In a market that refuses to sit still, high-yield dividend stocks offer something rare: predictability. You're not betting on the perfect timing or hoping for the next rally. You're getting paid steadily, regardless of the daily noise in the market. Dividend stocks aren't just about yield, they are about turning your portfolio into a source of real, ongoing income. But a word of caution: not all high yield dividend stocks are safe, and not all safe stocks will pay high dividends. Investors should evaluate the company's fundamentals, corporate governance, and valuations when conducting their due diligence before making an investment decision. Happy investing!